Welcome to our webinar, The Final Tangible Property Repair Regulations and Fixed Asset Review, Opportunities for 2019 and Beyond. Today's speaker will be the principal from our Chicago office, Lester Cook. KBKG was established in 1999. We have offices across the U.S., including Illinois, Arizona, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to tax preparers and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of tax preparers across the country. Now I'll introduce our speaker. Lester has nearly 20 years of experience in the tax specialty service industry. He is a principal of KBKG's Fixed Asset Review practice. He is a certified member of the American Society of Cost Segregation Professionals, a group that he has been a part of since 2008. Throughout his career, Lester has completed cost segregation analysis on thousands of properties ranging from office space leasehold improvements to multi-billion-dollar industrial complexes and hotel and resort projects. He has worked with many Fortune 500 companies, successfully representing his claims to both IRS and financial auditors. Prior to KBKG, Lester led the PwC Central Region Cost Segregation Center of Excellence, providing engineering-based cost segregation, project management, oversight, and expertise to all other fixed asset teams throughout the U.S. and Canada. He was a recipient of the 2008 PwC Greater Chicago Market Chairman's Award for Outstanding Leadership. Now I'll turn it over to Lester.
Thank you. Thank you very much. Appreciate the introduction. So just to go over a few of our learning objectives today. Upon the completion of this course, we should have understand the significance of the unit of property and how the 8 prescribed building systems, individual systems are defined, the definition of an improvement and how to evaluate that improvement using the BAR test, how to apply the tangible property regulations to building components, how to recognize retirements and how those can create some permanent tax savings. Also learning how to determine the basis of a removed building component. We'll get into a little bit about materials and supplies and how to deduct those. What the routine maintenance safe harbor is and how that applies to buildings. When the safe harbor for small taxpayers and the de minimis rules are applicable, and how the retail and restaurant industry safe harbor works and when it is useful. So a little bit of history related to the tangible property regs. These came out back in 2013. Actually, they came out multiple times, but when these came out, the final version of these, they were made effective for all tax years beginning on or after January 1st, 2014. They provide some rules for distinguishing the difference between what is a currently or immediately deductible expense in the current year as repair or maintenance, or whether that expenditure should be capitalized and depreciated. These regulations are under IRS section, Internal Revenue Code section 263-1, 2, and 3, the repair regs. 168I1 and 7 are related to general asset and mass asset accounts, and then 168I8 are related to the disposition regulations. Compliance for these tangible property regs was generally adopted via a Form 3115, an application for change in accounting method, and allowed for a Section 481A adjustment to comply with the regulations. One little keynote, we may get into this a little bit later, but the rules related to accounting method changes, there's a 5-year limit and a 5-year barrier that would preclude you from filing the same accounting method change on the same assets. And now we're getting to a point 20 2019, 2020 tax years, where we're approaching that 5-year scope limitation. And this may be a very topical issue to visit once again, because over the many years, I've seen many folks that have gone through the process and identified all of their potential repairs and maintenance opportunities, and then really haven't necessarily followed that accounting method change in the subsequent years. Now we're at a place where we can maybe go back and fix some of that stuff. So the tangible property regulations, others may call them the repair regs or the repair versus capitalization rules. The real issue here is that a lot of these rules are highly factual and really depend on certain specific facts and circumstances. The guidance that we have revolves around what constitutes a specific unit of property that's being repaired. So in order to determine whether something is a repair or maintenance expense, we must identify that unit of property. So to put into context, we've got a few examples here. We've got a $30,000 expenditure that was for 5 new plumbing fixtures, and the unit of property is the building. We'll get into this a little bit more detail. But in the small 5,000 square foot building, that's likely a capital improvement. If you put 5 new plumbing fixtures in the small building, it's probably an improvement. Spend that same $30,000 and put the same 5 fixtures in a significantly larger building. In this case, a 50,000 square foot building, that may be a repair. Again, we have to look at things based on the specific facts and circumstances, but it's not a total spend test. You could spend the same $30,000 in 2 different scenarios on the same exact property and come up with 2 entirely different answers. A general rule of thumb is that the smaller the unit of property, the more likely the expenditure that you received, that you incurred, you were going to have to capitalize. So what is a unit of property? There are a couple of tests related to a unit of property. The first one is the functional interdependence test, where that's more we run into this when we're talking about machinery or a product line or something of that sort. But essentially, this is a test where all of the components that are functionally interdependent of each other comprise a single unit of property. Think of a car engine, the pistons and the fan belts and all of that are all comprised are all functionally interdependent of each other, and they comprise a single unit of property, that engine. Components that are functionally interdependent, if placing them into service of one component is dependent of placing them into service of other components. So some other specialty rules that we have, there's a set of special rules related to plant property, of network assets meaning public utility lines, gas lines, electrical transmission, things like that. And then buildings and leasehold improvements, condos, co-ops, and that's really what we're going to focus on here today. Buildings, units of property. Now we're going to dig into this a little bit. So in the context of a building, the entire building and its structural components together constitute a single unit of property from a depreciation perspective. So notice here that a building structure consists of building and components other than the structural components designated as building systems. There are 8 specific systems that are outlined by the service in these regulations, and those include the HVAC system, the plumbing system, electrical system, elevators and escalators are their own separate items for whatever reason, the fire protection and alarm system, the security system, the gas distribution system, and then really the 9th system is kind of the rest of the building, the everything else. So what we have here is an opportunity to identify things out like walls, roofs, floors, that while they aren't their own separate unit of property, it is important to have those costs allocated and separated specifically to take advantage of other things that we're going to talk about, specifically related to dispositions. So for leased buildings, the unit of property it's a little bit different here. The unit of property is actually viewed in two different two different ways, depending on whether you're the lessor or the lessee. So if you are the lessor of the property, the entire building constitutes your unit of property. So as we talked about this last slide, the lessor needs to consider the basic building systems serving the entire building and evaluate the modifications or the expenditures related to those systems in that context. For the lessee, the unit of property is actually limited to the portion of the building that's subject to their lease. So any future improvements made to the lessee's space are combined into the existing unit of property under the lease. The building systems still must be considered. So, the plumbing system, the electrical system, all of that. However, it's only the portion that's within their lease space. So, the plumbing system in the lessee space might be limited to a break room and kitchen sinks. Perhaps they also have a dedicated restroom with associated plumbing fixtures, things like that. So, if we have an example here where the lessee was in the large building, remodels the dedicated restroom located in their space. If the lessee performs the work, it's likely going to be a capital improvement because the work was done on a major portion of their plumbing system located in their space. Now, let's say the flip side, the lessee occupies one floor of the 5 of the building, and the same work was done by the lessor. The lessor might be able to treat this as a repair expense because it only affects a small amount of the entire building, maybe 20% or maybe even less than. So again, very facts and circumstances derived. And it sure would be great to be able to say that it's a bright line test, but unfortunately the tangible property regs do not have any of that. So the last concept we really want to introduce here is about the unit of property is the depreciation consistency rule. It's very common to have multiple asset classifications with different recovery periods within the same building. We've discussed that in the building is a single unit of property and that there may have multiple building systems, but each of those systems within the building have multiple asset recovery periods. If the component of the building is a separate class of property, then it's treated as a separate unit of property. So, if you have a cost segregation study performed, typically we're identifying things like 5, 7, 15-year life makers property. Those items that were segregated out into different recovery periods are no longer part of that original building unit of property. So, let's take an example. We've had a cost seg study done on a hotel where a portion of the electrical system is segregated into asset class 57.0 with a 5-year recovery period, and a portion is segregated into asset class 00.3 with a 15-year life recovery period. So the 5-year recovery period assets could include some things like decorative lighting, decorative chandeliers, wall sconces, things like that. The 15-year might have an outdoor parking lot and the outdoor parking lot lighting associated with it. So any future expenditure to replace the decorative lighting should be compared to the 57.0 or the 5-year depreciable life associated with the lighting system, as opposed to the overall lighting system from a tangible property regulations perspective. So again, this depreciation consistency rule here reinforces previous comments about the importance of breaking out the buildings and summarizing the units of property included within those buildings. It's a very critical opportunity. So now we've talked about the unit of property, and now we say, well, geez, I've got an improvement to a unit of property. What is the definition of an improvement? And an improvement is actually defined in 263A through 3D, and that is defined as amounts paid after the property is placed into service, which is either a betterment to the unit of property, adapts the unit of property to a new or different use, or restores the unit of property. So that hence the BAR, the bar test. You guys may have seen this before or heard of this in the past. So long as one of those tests are passed or checked yes to, then that improvement or that expenditure is deemed to be an improvement. So what is a betterment? Well, a betterment is something that corrects a material condition or defect. And again, this is very facts and circumstance based, very very important to be able to tell the story. So, the words in here we've got underlined, you'll see 4 times, are material. What is a material condition or a defect? Or if we're talking about a material addition, an enlargement, expansion, an extension, what means material? Are we talking 10%, 20%, 50%? Unfortunately, again, the tangible property regulations have not really provided us with a bright line test, but they have given us a ton of different examples where we can, infer different perspectives from one to the other. A betterment is also a material increase in things like capacity, productivity, efficiency, strength, quality, or output. The photograph that we have here are some asphalt shingles where we may say, hey, we replaced our existing asphalt shingle roof with the solar panel shingle. The solar panel included asphalt shingles. Was an old roof, replaced it, put a new roof on. Well, that new roof significantly increases the efficiency of the unit of property, the building shell. It may increase the productivity, adding capacity from electrical standpoint, things like that. So all of this really is viewed as an improvement, as it's a betterment. So again, the last bullet point that we have here, materiality. The IRS has not defined materiality, and this may be an area of controversy, especially when you're talking about, well, I put an expansion onto my building that's 1% of the square footage of the building. Well, if the original building was 1 million square feet, that 1% is in relation to the original building, it may not be material, but it is a material size. So again, very facts and circumstance based. Couple examples here that we have, and these really came from the tangible property regulations themselves. We have asbestos removal it's not a betterment. The asbestos removal, and we'll get into maybe a little bit later, is in conjunction with other things may have to be a capitalized asset, but just in general, the removal of asbestos from a property is not deemed as a betterment. In a little example that we have here, we've got an assisted living facility that a taxpayer purchased. Right after the purchase and for the next 2 years while operating it, they spent a ton of money doing extensive repairs, so to bring the facility up to a higher quality. So what we would have here is this would be an amelioration of a previous condition, and it's a betterment. Thinking it through is, maybe the original price of the facility when it was acquired was discounted because of some of these things. Regardless, it was a known condition that needed to be, a fixed and brought to as a betterment. Reconfiguring office spaces to add more cubicles. Taxpayer spends $30,000. They add 50 more electrical outlets, data jacks. It's probably a betterment. Again, if they're adding 50 more electrical units or electrical outlets in somewhere where there's 5,000, maybe it's not, but something that's not a betterment, replacing wooden shingles that are no longer available with a comparable asphalt shingle, though it may be slightly stronger than the wood ones, technological advances are allowed for. Now, if we start talking about replacing the shingles with lightweight composite shingles, maintenance-free, 50-year warranties, now we're kind of comparing apples and oranges, and that would be a betterment. You're increasing efficiencies and things like that. So now that was the B. So now we're at the A from the bar test, the adaptation. So if we incur costs to adapt something to a newer use, then we have to capitalize those. So in our example here, we have a taxpayer. They want to convert their manufacturing business, a portion of their building, into a showroom. So they replace some lights, paint the walls, replace some other components. Just generally build out a nice little section of a showroom. The taxpayer has to capitalize that cost because they're adapting it from previously a manufacturing into a new commercial showroom, retail, what have you. So those would be deemed an adaptation to a new or different use. Now, if they only did items or only did construction for their manufacturing operation, then that might qualify as a repair or maintenance expenditure. Again, very facts and circumstance based. Excuse me, and very, very specific to how you tell the story behind all of it. The last question that we have to ask is the cost or is the expenditure that was incurred a restoration? And what is a restoration? Restoration happens if you replace a major component or a substantial structural part of a unit of property. A restoration occurs if you return a unit of property to an ordinary operating condition. It was in a state of disrepair, no longer functioning, now it's working. It's a restoration occurs if you rebuild a unit of property to a like new condition after the end of the class life of the property. Class lives, we would go to Rep Proc 8756 and look at the ADS life. So in a situation where maybe we have a piece of equipment, it's got a 5-year depreciable life, a 7-year or a 9-year depreciable life under ADS, and we rebuild that property or we rebuild that piece of equipment in year 12 because it's getting worn out. Well, the cost that we spend to build that up or to rebuild that to a like new condition, those would be capitalized. Those would no longer be maintenance costs. A restoration also occurs when you replace a component that's deducted as a loss. So if we adjust our basis, we have a casualty loss, the expenditures related to that are then capitalized. So we talked about a major component, or the restoration is replacement of a major component. So what is a major component? A major component is something that performs a discrete and critical function. In our case here, talking to the building system. So if we have our unit of property is the lighting, or our unit of property is electrical, a significant or major component would be the lighting system, or the air conditioning system in the HVAC, or the flooring as part of the overall building shell. It's water heater, etc. So a substantial structural part was another piece of there where we have this is a large physical portion of a building system or unit of property. So here we have an example of maybe we're replacing more than 50% of the lighting system. That would then be deemed a restoration to the lighting system, even if you're replacing the same incandescent lights with incandescent lights or LEDs with LEDs. It's still a restoration at that point. If you're replacing incandescents with LEDs, now you're talking about probably a betterment. So now you've checked both boxes. When we're talking about all of this stuff, really, I can't stress enough that it's really a facts and circumstances analysis. It's both quantitative and qualitative. It's not just the cost. It's not just the size. It's not just the function. It's a combination of all of that. One last thing we have on this slide here is if we're replacing an incidental component of a unit of property, it will not constitute a major component, even though it affects the function of the unit of properties. And here we have an example of thermostats. We see this quite a bit where I'm replacing my thermostats in the property. It's related to a substantial structural part or a major component, but it's not. So there's an opportunity to potentially expense those. Again, typically when you're replacing thermostats, though, you're replacing them with something that's going to make the building more efficient. So while it may not be a restoration, it's probably a betterment. So some examples of a restoration, we've gone through quite a bit here, but final regulations that have a restoration standards that you must apply to all of the major components of the unit of the unit of property or the building. So the first thing that we have to do is identify the major component of the system and then see if a significant portion was replaced. So this example here, we have an office building with an HVAC system. So unit of property is the HVAC. Excuse me, our significant components or our significant components are 3 furnaces, 3 AC units, and the ductwork throughout them that support them. 1 furnace goes out, we replace it with a new furnace, or we've got 3 furnaces that work together to perform the critical function of the HVAC. Those 3 furnaces are a major component. So replacing a single furnace, 33%, based on our examples that are in the regs, would say that that's not enough of replacing a significant portion of a major component to deem it a restoration. So then in this particular example, this would not be a restoration. Now, again, maybe that new furnace that was put in is significantly more efficient. It might be a betterment, but if we're talking like kind, it's not a restoration. So in another example here is, we've got an office building, 1 HVAC system. We've got a chiller, a boiler, a cooling tower. They replaced the chiller, something very comparable, so it's not a betterment. The chiller functions to cool its primary function is to cool water to generate air conditioning. The chiller itself performs its own discrete and critical function of the HVAC system. It replaced one of the 100% of that system is replaced. It's deemed a restoration of the system, and you would have to capitalize that. Now, same fact pattern, but we replaced one of the 4 chillers that were there. It would not be a restoration at that point. Again, all facts considered, in this specific instance, that would be a repair, or a repair, maintenance, and current year expense. I think this is our last one of these. We have an office HVAC. It has 10 rooftop units for the different areas. It's got controls that allow us to distribute the heat and AC throughout the various spaces of the building. Had some problems with climate control and the AC, hot spots, cold spots, things like that. The owner realizes that they need to replace 3 of the rooftop units. The 10 units altogether function as a major component of the HVAC system. They replace 3. Again, it's 30%. It's not a significant portion of the major component. It's not a substantial structural part of the HVAC system. It's not a restoration. If they're like kind and not meeting any of the betterment standard that we went through, this would be a repair expense. Something else to kind of remember here too is even if they are deemed as a capital improvement and you would have to capitalize them, under 179, there may be an opportunity to expense those as a 179 expense. Again, depends on facts and circumstances of the specific taxpayer and things like that. But same goes for roofs, fire protection, alarm systems. Here we've just got some visual examples. The rooftop units that we were talking about in the last example here on the left-hand side, and then on the right we've got some condenser units for the air conditionings. And in this case, you can kind of see where in the foreground we have a newer unit, small, flatter, and then in the back were the first ones they put in, the taller units. They replaced one of the 4. It's similar in nature. Those were deemed as an expense, or that replacement of that one of the 4 was deemed an expense through one of our analyses. On our website, we have a little bit of technical article. It's called the KBKG, the Guide to Expensing Roof Costs. We run into this very frequently. What do we do with our our roofs, how do we determine, you know, whether we need to capitalize or need to expense or, you know, what have you. So, you know, in order to analyze all of that, we put together this document, this how-to really. The very first thing that you need to do is determine your unit of property. Where does the roof at? Well, it's under the rest of the building, the building shell, you know, unit of property component. Next thing we need to do is determine what the substantial structural part is or the major component is, and it's the roof system. And then we need to now analyze. So step one in that analysis is we have to determine what type of roof is it. You know, is it a steep pitch roof? Is it a low pitch roof? What are the components of that roofing system? And these are all photos that are pulled directly from our how-to guide. But you know, having to understand whether we're talking about replacing the roof covering, or we're replacing the roof deck, or we're replacing just the membrane or the decking or any of that stuff. It's all very critical and very important to understand in determining whether the cost is an expense or needs to be capitalized. So the next thing that you have to do is, once you determine all of that, is apply the tangible property regs. And these are a list of questions that we ask when we're analyzing any of these costs, that we would advise anybody to ask as they're incurring these costs or trying to appropriately categorize. First thing is, why was the roof replaced? Well, you know, oh, the roof was replaced because it's the roof that was on here when we built it 50 years ago. Well, probably in a restoration point then. Or, you know, a tree fell on it, knocked a hole in it, and we took a disposition. It's probably a restoration. Or, you know, how much of each layer was replaced? Did you entirely rip the roof, the entire roof off itself, including the underlayment and the decking, or did we just kind of peel the shingles off the top and put new shingles on? Because again, that's a different answer, depending on how much of that significant structural component we're removing. Depends on, is a critical factor. Was the replacement because the previous structure was in a state of disrepair? Did the taxpayer claim a partial loss? And both things that I mentioned in the first one of why it was replaced. How much time has elapsed between the building acquisition and when the roof was completed? Again, you know, if you just bought a property and 6 months later you're putting a new roof on, was the basis, you know, of the roof work kind of assumed that it was going to happen? Was the price of the building already discounted for that bad roof? You know, a multitude of different things. What kind of roof did you previously have? What did you replace it with? Back to that example, you know, I had old wooden shingles and I put on this great new metal roof that's state of the art, that's going to last for 100 years, and it's probably a betterment at that point. So, and then the last bullet point here that we have is, was the new roofing project related to a physical enlargement? You know, as you doubled the size of the property and you said, well, let's put a new roof on to make everything match and, you know, get rid of any of the little leaks and stuff we had and just make it all continuous. You know, that's a different answer. So, you know, applying all of these questions, or, you know, coming up with answers to all of these questions will absolutely help with determining whether that roofing cost should be an expense or a capital improvement. So we'll go through a few examples here. We've got a taxpayer X. They own a retail store and they find out they've got a leak in their roof. They go on the roof, they replace 60% of the roof decking, the roof insulation, the roof membrane. Significant chunks of this, well, that's going to be a restoration. It's an improvement they have to capitalize. The great thing, and we'll get into the dispositions later, but for every improvement, there's usually an equal and opposite disposition that can be identified and taken advantage of. So in this case, you know, 60% of the roof decking, insulation, and membrane of the existing roof should be disposed of, and a deduction taken associated with it. Next example, we have taxpayer Y. They own a factory building with a roof and comprised of a roof and structural elements, insulation, and waterproof membrane. So a giant flat roof. So the taxpayer replaces only the membrane that's on the roof with a comparable new membrane. So it's clearly not a betterment. The roof membrane is just a small portion of the entire system, because we've got things like insulation, we've got the deck, we've got all of that other stuff that goes with it. So this is not a restoration. It's not a betterment. We didn't change the use of the building. It's a repair expense. Some other examples that we have here is a slurry coat seal that you'll see on asphalt paving. You know, things like that, or the asphalt crack repair. Very often we see these. These are examples of, you know, things that are not restorations. These are things that should be a current year expense, repair and maintenance type activities. So we touched on briefly a little bit about retirements. So as part of these regulations, there were some concurrent regs related to dispositions. So historically, we weren't allowed to take partial dispositions on properties. You know, it was kind of the all or nothing. And for GAAP purposes, we were still taking those dispositions, and you'd have some differences between tax and book. But now these final disposition regs that were issued back in August of 2014, they allow you to take a loss deduction where a taxpayer may remove anything from a building. So for example, you pay $50,000 to replace all of your HVAC units, and now you need to capitalize that amount. You figure that out. $50,000 was recovered over 39 years. However, throughout that, you figure out that there's a lot of basis left in our old HVAC units. Let's identify the costs that were associated with those. Let's take the net tax value of those as a disposition, and now we can offset somewhat some of those costs of that new asset that we had to create. This bottom section here we've got is the KBKG Solutions website. We actually have a partial disposition calculator that would allow for you to go in and put in the type of expenditure that you have, add a few different items in, cost, original acquisition, things like that, and it will help you come up with a value for some of these assets so that you can take a partial disposition on. So example here, retirement of some structural components. Taxpayer acquired a building for $5 million in 2012. 2019, they spent $1 million to remodel a portion of the second floor. They gutted some of the walls, ceilings, lighting, etc. As part of this improvement, they also had a cost seg study done. And while we were looking at that, we also have a retirement study where we identify that the original cost of that second floor, those components that they demolished, was $470,000 of that $5 million that they spent in 2012. Well, the depreciation between 2012 and 2019 leaves them with a $404,000 cost basis that they're able to deduct as a current year disposition, and again helps offset some of these costs associated with the new expenditure that they've got, that they've learned that they've had to capitalize. All of this being said, there's also some opportunity to create some permanent tax savings with retirements. So if you correctly continue to depreciate your 1245 or 1250 property that was removed from a building, if you incorrectly, I'm sorry, misspoke there. If you incorrectly continue to depreciate it and then you sell that property, you're going to have recapture tax. So, you know, 1245 property is recaptured in ordinary, 1250s at capital gains, or 1250s at 25%, capital gains are typically 20%. So, you know, if you have these costs that are essentially ghost assets on your ledger, you're going to, and you remove those timely, then you're going to create some permanent tax savings when it comes to selling those properties. So here's our example. This was our $5 million building. We had $470,000 of retirements in. Let's say they didn't do the retirements and they had $470,000, and they recapture all of that upon sale. And, you know, let's say there's $370,000 of that was 39-year life property and $100,000 was 7-year life property. The recapture tax on all of that would be $129,000. If they did a retirement analysis, we identified those $470,000. The recapture tax on that's $0. The capital gains tax on it's $94,000. So in this specific instance, because they went through and identified those dispositions, we have a permanent tax savings of $35,500 upon the sale of that particular property. So removal costs and demolition, there's a little bit of a change with respect to those as part of the tangible property regulations. The old rule was that removal costs of an asset needed to be capitalized and depreciated with respect to the new asset. It's essentially a soft cost, an indirect allocable cost. The current rule says that removal costs of an asset or a component of an asset can be deducted if the taxpayer realizes the gain or loss of an old component. So the example we have here, landlord owns 3 commercial units, and they pay $200,000 for improvements in each space in year 1. In year 5, the tenant leaves. New tenant requires the landlord to gut and renovate the space. Contractor cost detail that they receive says $40,000 of the $340 is related to demolition to remove those old components. So the landlord can expense that $40,000 in demolition costs so long as they take deductions and dispose of the remaining portion of the $200,000 of original improvements that they had spent. If they choose to not identify those disposition costs, then that $40,000 goes back in as an indirect cost and is allocable and depreciated. A significant portion would be depreciated over 39 years. So again, a double hit here. You're allowed to take your partial disposition deduction as well as your demolition deduction. Caveat with all of this is it all must be done on a timely filed return. There's no mechanism to go back and file an accounting method change to pick up some of these missed partial dispositions. All of that has to happen on a timely filed return. So this slide here, we've got determining the basis of a removed component. So great, you tell me I can identify all of these dispositions. How do I do that? Well, the first and foremost, the easiest way is to have a very detailed cost segregation study performed on the front end. So then 5 years, 10 years from now, when you're doing your dispositions, you'll have that detail. If that's not the case, then you can always have a cost seg study done retroactively and identify all of those components. Also catch up any missed depreciation via 5, 7, 15-year life assets via IRS Form 3115. So first and foremost, a cost seg study is probably your best bet. You can utilize the discount cost replacement component utilizing the producer pricing index. And again, this goes back to my slides a few ago that talk about the partial disposition calculator. That's what our calculator is based upon. It's the producer pricing index. The one thing about the PPI index and the partial disposition calculator is that you can use that for restorations, but you can't really use it for betterments or adaptations. And the reason there is, you're starting with an actual cost. You say, okay, great, I've got a cost of $3,000 for my new windows, and I incurred those today, but my old windows I had 10 years ago, so let me producer price index my cost of the windows to 10 years ago, and that would be my original basis. But what if you're putting in ultra high efficiency thermal pane windows and the old windows you had were not? Then you're definitely skewing everything. So the PPI methodology is really designed for restoration replacements. The identification of things where a betterment happens is really done best by a reverse engineering study, cost segregation study, things like that. To further that dialogue, if you do utilize that discounting method, it can grossly overstate, right? So in this specific example we've got here, we bought a building 3 years ago. The owner spent $200,000 to replace those windows. We discount that $200,000 using the PPI back to $186,000, and we don't apply any type of condition factor. So, you know, it's, let's say that those windows were really in bad shape, we've got a condition factor that we should apply. So the normal life of windows via valuation techniques and things like that is 20 years. So we apply an appropriate condition factor of about 27%, meaning that that $200,000 that was spent in the current year is really trended back to a $50,000, which is more representative of the value of the windows at that point in time. And again, that's how our tool is designed to work. But again, the absolute best case scenario is always a detailed cost seg study of it all. So we're going to go through these a little bit quickly here. Materials and supplies, again, as I talked about, materials and supplies are tangible, non-inventory property used and consumed in your operations. We're talking about, you know, things that are consumables, fuel, lubricants, water, things that have a 12-month or less life expectancy, and then generally speaking, anything that's $200 or less a unit of property. How do we deduct those? Incidental materials and supplies, there's no records of consumption. We deduct those when they're paid or incurred. Non-incidentals, we do have a record, a tool crib, things like that. You deduct those when they're used and consumed. And then we also have the de minimis safe harbor. If you elect the de minimis safe harbor, then materials and supplies are wrapped up into that, and then you have to you deduct those when they're paid or incurred. Just a couple examples here of materials and supplies. We had a taxpayer, they were unable to utilize the de minimis safe harbor for their waste receptacles because you have to follow GAAP, and GAAP didn't want to expense those. But we found that, you know, they were less than $200, so they fall into the category of materials and supplies. So there was definitely an opportunity for materials and supplies utilization, and taxpayer was able to deduct those. Routine maintenance safe harbor. So if you have an expense that you reasonably expect to perform more than once during the class life of an asset, you can make this routine maintenance safe harbor election on an annual basis. For buildings, it's not the class life, the ADS life, it's a 10-year period. So if you incur an expense every 5 years on something like an escalators, you know, you can utilize the routine maintenance safe harbor. So this may work for your question related to the light bulbs. If you're replacing those more than once every 10 years, you have an opportunity for routine maintenance safe harbor. We also have a safe harbor for small taxpayers with respect to the tangible property regs. Small taxpayers defined as less than 10 million in average annual receipts over the last 3 years. If it's an eligible building, if the unadjusted basis is 1 million or less, and you can elect to expense amounts, you know, less than or equal to $10,000 or 2% of the unadjusted basis of the building. So, you know, here we have an opportunity where, you know, if you do a cost seg study, we may be able to reduce the real property basis enough to make that property eligible for this election. So, for example, we have a 39 or a building before cost seg was a $1.3 million building. It wouldn't qualify for the small taxpayer safe harbor. But after the cost seg, we identify a bunch of non-building property. You've got 900,000. You know, now you can utilize that small taxpayer safe harbor. Plan of rehabilitation, you may be familiar with this. This was from many years ago. The plan of rehabilitation has really been made obsolete. What that said was if you did repairs to a building as a bigger part of the project, you were forced to capitalize. Now the rule is really, if those costs were not incurred by reason of the improvement, they can be expensed. So what we have, you know, these examples, we've had a taxpayer, they spent $500,000 to rewire a building for new lights. Because they did that work, they also had to spend $30,000 to fix the drywall. They have to capitalize all of that. Now the other fact pattern is we've got a client spent $500,000 to rewire and upgrade electrical. They spent $30,000 to patch and paint areas that were not related to those improvements. That $30,000 could be expensed because it was a repair unrelated to any improvement. We often see this with painting. You know, folks may see painting and go, oh, you know, painting, I'm going to expense that. Well, but if that painting of the entire building was also part of, you know, the expansion that was built and all of this, then it probably was incurred by reason of the improvement, and is an area where, you know, a person may have a foot fault. So the de minimis safe harbor, we talked a little bit about this. It's a safe harbor that a taxpayer can utilize if they have financial statements, applicable financial statements of $5,000 per item or per invoice for property, must have an expense policy in place, and they must treat things the same for both book and for tax. If you're a taxpayer without an applicable financial statement, then the threshold is cut in half. It's $2,500 per item. So, and in this specific instance, you don't need an expense policy. So in here quickly, the definition of an applicable financial statement, you know, it's something that you file with SEC, or it's a certified audited financial statement, you know, that's used for credit purposes, for reporting to shareholders, or any substantial non-tax purpose. It's a pretty broad definition. The restaurant retail safe harbor revenue procedure 2015-56 provides a special treatment to companies that fall into the restaurant and retail industry, that allows them to immediately deduct 75% of their qualified expenditures, and capitalize the remaining 25%, so long as they adopt this method and utilize that going forward. A lot of this is kind of changed now with the advent of 100% bonus on qualified improvement property, but generally this is really related to restaurateurs and retailers that are just updating the appearance of their properties, you know, doing a refreshing, a remodeling. We've published many white papers on this. I would point to our website to get into more detail with this specific topic. So the restaurant safe harbor, when I talked about qualified property, what it doesn't include, when you have to kind of go through your total expenditures, you have to strip out all of the 1245 property, the intangibles, the land, any types of material additions, you know, any restoration, casualty loss related stuff, and really you're left with costs that were associated with a remodel refresh. You identify all of that, you're able to expense 75%, capitalize 25% immediately. And then in the last few years here, that the IRS has actually released an audit technique guide of how to handle tangible property regulations. I would point again to both to our website and to the IRS website. It's a very, very robust audit techniques guide that you know, helps understand what the service is really looking for when it comes to one of these types of analyses. All of this is done via an accounting method change. Just touched on that briefly at the beginning. You know, we've got a 5-year scope limitation that some of us are rapidly approaching. But here's just a list of really related to depreciation in general. 7, repairs and maintenance is change number 184, and then disposition of full assets is change number 205. How we can help? We've got a dedicated team of experts. We go through this. We live, breathe, die depreciation and all things tangible property, regs, cost segregation, green energy related. You know, we can look through fixed asset ledgers, identify any of these opportunities, help with the 3115 preparation. We've got software that helps us out, do all of this stuff. And most importantly, we help tell the story. Talked a little bit about it. I would point everybody to our solutions software website. On there, you'll see the partial disposition calculator that we talked about. There's also some special other tools. We have a separate webinar that's really dedicated to just this. I would encourage everybody to participate in that as well, to learn more about each of those individual tools.